So guys, here is a special invitation for Investival, which is an investors conclave, which is going to happen in Bangalore in the month of April from 28th to 30th. This is a 3-day event, which will be a residential event. This is been happening, will happen in Taj Yeshwanthpur, Bangalore. It is a purely investors conclave where we are inviting very big names as investors. They will be sharing you a lot of topics on value investing, techno fundamental investing, momentum investing. We have categorized the themes. On the basis of the theme, the expertise will come and they will talk about they will share you the strategies and the investment ideas so that you can utilize in your investing journey. Next slide, sir.
Hi, hello friends. Welcome everyone to Nifty Banker, India's first retail index traders online conference. I'm Ashok Devanampriya, the CEO of Traders Gurukul and also the host for your today's program. It's a great pleasure and honor to welcome every one of you to the third edition of this wonderful webinar series. I'm sure by the end of this program, you will have extensive knowledge in terms of trading index in particular. Before we kick off this session, I would like to thank our media partner Money Control Pro, the largest financial portal in India with millions of daily readership on their website. They helped us to reach a wider audience in a short period of time. The speaker for today is Mr. Kushal Jain, who is the CEO of AlgoFox. He is going to empower us today with his special topic, IV and probability based setup. Well, Vishal is a good friend. He has been in the trading world from the last 8 to 10 years, and he's one of the successful algo platform developers in India. I have been in touch with him from quite some time, and he is also a speaker in most of our Traders Gurukul events. Well, Kushal, on behalf of Traders Gurukul and Money Control Pro, I extend my warm welcome into this program as a speaker. Go ahead, my friend. The stage is yours.
Thank you so much, Ashok sir, Traders Gurukul team and Money Control Pro for providing me this opportunity. I hope I am audible. If yes, sir, Ashok sir, you can just confirm me. Am I audible, sir? Okay, I guess I am audible. And we'll move ahead. Today, we are going to talk about IV and probability based setup. To all who are attending this session, who are watching this session, I want one thing from you guys, and that is you should be an energetic learner. So whenever we learn something, whenever we are acquiring a skill, especially in the night time when the entire day is over, our energies also get drained. We need to keep ourselves motivated. We need to keep ourselves energetic to basically absorb whatever we are learning. And trust me, in the next 2 hours, I'm going to talk about something that very few people might know, or I think majority of you might have never even heard about these things, and how exactly combining mathematical models you can bring a sustainable income to your trading journey, right? So I am practicing these strategies that I'm going to teach you from in my own personal demat account. I'm also going to show you the reports and how we work on them and how we can use free tools to make sure we never miss opportunities. So having said that, let's just start. Concept which is based upon IV, that is implied volatility, and probability based setup. The beauty of these setups is that not only they work for indices, but they work really well for even stocks as well. So any script which works on Black-Scholes model, there you can use this setup and you will find amazing returns and amazing accuracy in your trading. So talking about VIX, IV and probability based setup, my name is Kushal. I am CEO of AlgoFox. We at AlgoFox provide algorithmic trading solution. I'm not going to talk about that because that is something that you can explore on your own later, maybe. Talking about myself, I'm basically having more than 11 years of trading experience in investing and trading. In the last 4.5 years, we have created more than 3,000 algorithms for retail traders, investors across the world, HNI traders, prop desks across the world, and institutions. I'm also a full-time trader and I run my own algo on fund of 1.3 CR. I'm also going to show you the reports of that fund as well. And I basically use mathematical models, statistics and probability only. So when I started my trading journey around 11-12 years ago, I was purely a technical analyst. I used to see charts, apply indicators like moving average, MACD, RSI, Bollinger Band. I have tried different types of indicators, different time frames, different types of candlesticks, basically everything that a retail trader goes through. I've taken multiple courses, multiple workshops, and then finally I just realized that technical indicators or technical analysis is not my cup of tea. It might be good, but it is not my cup of tea at all. Then I shifted to price action setup, demand supply zone, etc, etc. But then again I realized that price action is something that also does not provide me any edge, and again it is not my cup of tea. Might be there are good price action traders who are able to find good price actions in the chart, but I somehow feel it is not my cup of tea, so I just quit that also. I tried my hands with fundamental analysis, and then eventually I thought I should develop my own systems which gives me an edge, because anything and everything that is in market is all based upon probability only, right? For example, if I'm using moving average crossover, just to help you understand what I'm trying to convey here, if I am using moving average crossover, and let us say when there is an EMA crossover, whenever let us say 20-day moving average crosses 50-day moving average towards upside, if there is a buy signal generated, the probability of it working in my favor is not sure until and unless the entire trade is over. It is still 50-50. So no matter whether what indicators I use, what price action I use, at the end the probability edge is never above 50%. It might go in my favor or it might not go in my favor. But I wanted to develop some mathematical models or some setup where the probability or the winning edge is in my favor, maybe let us say 70% or 80% in my favor, and only 10, 20 or 30% against me, right? So I'll give you an idea on how exactly you can build your own mathematical models, and how I have built my simple models which are very effective. And of course, we at AlgoFox, we conduct workshops every weekend. Every Sunday we conduct workshops, and so far in our journey we have trained more than 35,000 users about stock markets and algo trading workshops. And of course, the last point might be a little unrealistic to believe in, that I have actually created a mathematical model with an accuracy of 92%. The returns are not that good. I mean, percentage wise they are very, very decent, but what matters here is accuracy. I'm also going to showcase you how exactly that works. We have given an accuracy of around 92% in my real trading account. So there are two types of traders who are in the market. One for whom accuracy does not matter, ROI matters. Others, for them ROI does not matter much. It is good if we are able to make 3 to 4% a month, but the accuracy matters a lot. So I am into second category, where if I'm making 4 to 5% a month, but if my accuracy is really good, I am happy. So that is something that I've built upon. And of course, I'm a BTech dropout, but I'm certified by NCFM and NISM. I've given several exams. And of course, since I'm into algo trading, so I started learning about Python. I've completed a few courses on Python as well. All right, so talking about today's content, what we are going to learn today in detail is, firstly, we are going to identify reversal pattern with probability model. Now when we talk about reversal pattern, the main thing that a trader should do while finding a reversal pattern is understand when the market is about to reverse. Let us explore few examples, right, and then take it ahead from there. For example, I'll just go to trading view, and we are going to see some charts of maybe bank nifty itself, right? Let's say bank nifty, and I'm just going to remove all the other Pine scripts that I've developed. So I'm just going to remove everything. All right, so this is a bank nifty 15 minutes chart, and I think we'll go to a normal candlestick. instead of 15 minutes chart, I'll just go to a bigger time frame, maybe a daily time frame, just to explain you what exactly do we mean by finding good trading opportunity. Let us say the market has gone down here, and after market has gone down here, market has reversed. So if I was supposed to find the reversal here, I could have applied multiple indicators, multiple transaction setups, multiple demand supply zone. But in spite of doing all of that, there is no way that I could have predicted that market might reverse from here until and unless this move is complete. Similarly, when the market is going up, after the market has gone up, further reversal, I could not have predicted that the market might reverse from this point. Similarly, I can give n number of examples. Let us say market made a top here. What is the how do I predict whether the market is going to reverse? Well, there is of course no correct answer to this also. Again, from here, will the market reverse? Again, there is no correct answer for all of these questions. So now, instead of finding or instead of building an indicator or a calculation on how exactly, where exactly the market will reverse, I am just going to take you to play a game where we are going to learn how to understand from where exactly market can reverse. Of course, market might not reverse from that point, but what I want to teach you here is basically give you a gut feeling on building more of your winning edges. For example, let us say we want to flip a coin, right? And let us say head is basically trend continuation, and let us say tail is trend reversal. Okay, so head is basically, if I flip a coin, and if it is head, that means trend will continue, and if it is tail, that means trend will reverse. Now let us say for every time the trend is going to continue, let us say we'll take an example of bull run, right? We'll take an example of bull run, and let us say for every head, that means for every trend continuation, we'll say that bank nifty has formed a green candle. Let us assume this way. So one of the easiest mathematical model to identify small trend reversals. Okay, so I'm just going to teach you how to identify small trend reversals, and based upon those reversals, how can we make money in the markets. So again, as I said, let us say market today has gone up by, let us say, 300-400 points. So we have, let us say, a green candle. Let us assume. So we had basically a head. Now after one head, if I flip a coin again, forget about bull run, bear run, everything. Let us say I flipped the coin and you had to bet, and let us say first coin I got a head. You might have bet on head, then you are right. If you had bet on tail, then you lost your money here, right? Now second time I'll again flip a coin. Now probability of getting two heads on the go are very less. For example, head के बाद head आना is a little less probable than head के बाद tail आना या tail के बाद tail आना, so forth and so on, because now we have more probability, because now we are moving with two different incidents. Similarly, let us say even if there is a head again, that means we have another green candle. So we had a market somewhere here, it moved slightly up. Now after two head, if I flip a coin, the probability of getting three head on a stretch is a little more or lesser. But let us say if I get one more head again, then there is one more green candle here. Now I'll tell you, this is one simple mathematical model to identify trend reversal. So if there are three back-to-back green or three back-to-back red candle, then you might have even learned a lot about Japanese candlesticks, that when there are three consecutive green candles or three consecutive red candles, there is a formation of morning star, evening star, and different types of pattern. It all builds upon these mathematical models, right? So if there are three consecutive green candle, the fourth candle becoming red is a very high probability. But let us say if I want to play it very safe, I can wait maybe for another head. So now we have four consecutive green candles. So after four consecutive green days or bullish days, will the market take a small correction? Might be. Will market take small break? It is very highly probable, right? And if I'm even more conservative, if I want to believe that, okay, I want to play it very safe, what I can do is maybe I can wait for one more head, right? That means one more green candle, right? And after this I can play a bet that, for example, if the bank nifty was at 38,000 here, and next day it went to 38,300, next day 38,600, I'm just giving an example, 38,900 and 39,200, then taking a short position somewhere here will be less risky. Remember, just try to understand what I'm teaching here. At this position, when the market was at 38,000, if we would have applied any indicator